Jesse, right now the market is obsessed with one thing: free cash flow.
And of course, we'll explain what free cash flow is and why it matters to you, dear, gentle, self-directed investor. Can you tell I've been watching Bridgerton lately?
Yes, I have. Great season. Very Cinderella.
Every time a new AI model drops, whether it's DeepSeek, Claude, or the next breakthrough tool, investors start asking the same question. Is this innovation? Or is it about to destroy someone else's business model that you may or may not be invested in? You know, I feel like I've seen this film before, and I didn't like the ending.
25 years ago, investors were pouring money into companies that promised to change the world through the internet, and some of them did. So Amazon survived and became one of the most powerful companies on earth, really. Others, like Pets.com, they burned through millions of dollars and disappeared almost overnight. And the difference between those companies holds one of the most important lessons in investing. Growth is very exciting. The hype is very exciting, but cash flow keeps companies alive. Management.
Well, yeah, your money has to actually make money for this whole investing thing to work. So today, we're going back to the aftermath of the dot-com bubble to really understand why markets behave the way they do when revolutionary technology appears, and why investors are suddenly so nervous about AI.
Yes, this is part 2 and the exciting conclusion of our dot-com bubble rabbit hole.
This is the Market Maker podcast, where two friends teach and learn investing education to all levels of self-directed investors by breaking down how markets work in a way that actually makes sense. But it's from her perspective.
That's right. You're in for fun financial literacy analogies that you probably haven't heard before because it's from the minds of two women.
Finance sisters, if you will.
I'm Jess Inskip. I act as a teacher, a formally licensed finance expert with over 15 years of self-directed investing experience. You may have seen me on popular finance media TV shows or on Instagram and TikTok and all the social media places.
And I'm Jessie Denui, the student and beginner investor who wants us all to learn how to do that thing rich people do, where we make our money make money, and how the system really works. I'm not afraid to ask the questions we're all thinking, and I stop Jess when she gets jargony.
Together, we're on a mission to make you fin-fluent, not fin-fluenced.
Okay, Jess. First, I have to ask the obvious question. If the internet revolution created both Amazon and Pets.com, and today AI is shaking entire industries every time a new model drops, how do investors actually tell the difference between a revolutionary company and one that's just riding the hype like we saw in the dot-com era and talked about in part 1? Because if the market seems, I guess, anxious, scared, needing constant validation, volatile, I can go on. If we're seeing echoes of the dot-com bubble in today's AI boom, then I'm going to need you to address all my questions today and tell me what is on the agenda for this episode.
Oh, these are great questions and very valid thoughts. So today we are continuing our deep dive into the dot-com bubble and look at what happened after the crash, and more importantly, what lessons investors still use today so we can apply it to the AI boom. So here's what we're going to cover. First, 2 case studies from the bubble, Pets.com and Amazon, and the critical difference between hype and a real business model, because that's what those two are. Why free cash flow and a path to profitability became the defining lesson investors took from the crash. What happened to the tech industry, investors, and the broader economy after the bubble burst. The aftermath is important. How the collapse actually built the foundation for the modern internet economy. And then finally, the long-term investing lessons and why these same themes are showing up again today in the AI revolution. Like, that's the whole episode right there.
Okay, well, let's start with the case studies and go back to the late 1900s and my favorite decade, the 90s.
All right, Jesse, we're going to look at 2 companies from the dot-com bubble, one that failed spectacularly, Pets.com, the little sock puppet thing, and one that survived the crash and eventually became one of the biggest companies in the world, Amazon.
Yeah, we all know who won that battle.
You do know, yes. But in 1999, investors, they honestly didn't. And that's the lesson here. The difference between hype and a real business actually comes down to one thing: cash. Like, where is the money? More specifically, though, it's free cash flow and a clear path to profitability. So if you have cash, do you know what to do with it?
Yeah, we're going to pause there.
Okay.
Free cash flow, quote unquote. That sounds like one of those terms finance people toss around, like everyone should just magically know what that means. And I know I've tried to get you to explain it to me before, and I still don't get it.
That's completely fair. Let's break it down. Free cash flow is the money a company has left after it pays all its operating costs and invests in the business. So things like warehouses, equipment, or technology, the cost to operate, and then if they invest to expand sales. So think of it as the actual cash a company generates that it can use however it wants. This is like your excess. So pay debt, invest, buy back stock, or simply survive another year.
So is that different from the profit margin? And is this where we hear people talk about OPEX, operating expenses, and CapEx, capital expenditure or expenses?
It is related, but it is not the same. And I think this is going to be a rare moment where I don't answer your question because
that needs to be a whole episode, I'm assuming. Okay.
It does. I think we should have a whole series on how to read a balance sheet. But profit margin is your cushion that you have. So free cash flow is a component of that. And OPEX and CapEx is just what you're spending on. So they're related, but different.
Okay. So basically, cash flow tells us if the company is making real money and not just growing fast.
Exactly. Growth without cash eventually runs into a wall. And during the dot-com bubble, a lot of companies slammed right into that wall. Like if you are very dependent on borrowing or spending cash to make money, if that cash, like a faucet, runs out, it's going to dry up, basically. Which brings us to pets.com, our first use case.
Case study number 1, Pets.com, the poster child of .com failure.
Pets.com launched in 1998, selling pet supplies online. And they became instantly famous because we all love our pets, right? Like we spend so much money on it. Not because of their business model, but because of their marketing, which is so, so important. But we didn't have social media then. So think about that. They had a sock puppet dog mascot that showed up everywhere, commercials, talk shows, and that was the famous Super Bowl ad in January of 2000. And actually, one of our followers was a part of creating that ad, I recently learned. So yeah, right?
That's interesting. That sounds expensive. So I hope that follower made some good money off of that if they were in the marketing department or like the other side of that.
Very, yes. And I hope they did. But that's the problem, is the expensive aspect. So in February of 2000, pets.com went public. The hype was there because of the marketing, and they raised $82.5 million in its IPO. So they got an influx of cash. We go public to raise capital, as we said on episode 3, What is a Stock? So the stock debuted around $11 a share, and at one point traded above $14 a share in percentage terms. That's a big jump. And that gave the company a market cap of over $300 million. They were worth $300 million.
So that was just for selling dog food online?
That is correct. But they were selling the dog food online at a loss. Pet food is heavy. Shipping is expensive. And pets.com was actually losing money on nearly every single order just to grow quickly. So it was growth over profitability.
Yeah, they were basically just paying people to buy dog food at that point.
Yeah, pretty much. And instead of fixing the economics, they doubled down on marketing because the market does move on vibes. If you believe something has potential, there will be an underlying bid. That's the terminology, which means people buy into that potential. And then the reality check comes with earnings, or when the money runs out. But they had huge ad budgets, celebrity promotions, brand awareness campaigns, all while the business itself, it wasn't profitable. They burned through their IPO cash in 9 months, the time it takes to cook a baby.
Yikes. That's $82.5 million they blew through in 9 months. Like, that's a lot. And back then, it was even more.
Oh, yeah, it was. But by November 2000, Pets.com shut down completely and the stock collapsed to 22 cents per share when the bankruptcy was announced. So just complete collapse from a $300 million in value to nearly zero in less than a year. And they even auctioned off the sock puppet.
Oh, you mean the mascot survived longer than the company?
Yeah, it did actually. But Pets.com became the symbol of what went wrong during the bubble. Growth without a sustainable business model. There was hype, there was marketing, but there was no clear path to profitability.
Sad ending for Pets.com and all their investors. All right. Time for case study number 2. Amazon. From .com crash to .com dominance.
So let's compare the two. Amazon was founded in 1994, went public in 1997, 3 years later, but as an online bookstore, which I know you knew, but maybe our listeners don't. During that .com boom, it started expanding into selling everything. It adjusted. It was more agile. By 1999, Amazon stock had exploded to around $90 to $100 per share, and the company was worth more than $30 billion, with a B there.
But were they profitable?
No, not at all. Amazon was actually losing money at the time. And when the bubble burst, investors punished it hard. The stock crashed from around $100 in 1999 to about $7 by 2001. Like that's a big punishment. That's a 90% drop.
So investors thought Amazon was going to be another Pets.com.
Exactly. In fact, a Barron's article in 2000, so this was like the big warning and power of the media, warned that Amazon could run out of cash within 10 months if it didn't stop burning money. But here's the very big difference. Amazon had something Pets.com didn't: a scalable business model and infrastructure, a clear path to profitability. Jeff Bezos kept investing in warehouses, logistics, and technology, building the backbone of what would become modern e-commerce. We didn't know that was going to happen out of the .com boom, and we're such a consumption economy, and completely changed it. The company did something very critical after the crash, though. This is a key differentiator. It tightened spending and improved efficiency. So again, agility. By 2000 to 2004, Amazon posted its first full year profit. And that's what you want to see from a growth company, one that's of value.
So the long-term vision that Amazon had actually worked. It panned out.
Exactly. Amazon survived long enough for the internet economy to catch up with its business model because it had a clear path to profitability. You do need to spend money to make money, but there needs to be a path for that. You spend less and less and less and less, not spend more and more to have the same outcome. One is positive, the other one is negative. So the infrastructure it built during the bubble, which were warehouses, distribution centers, brand recognition, it eventually turned into the dominant e-commerce company, like the most biggest dominant e-commerce company in the world.
I understand layoffs are a component of that profitability and like profit margin and whatever. But is that also an indicator that management is bad because they like maybe hired too many people? Or should that be an indicator?
Yes.
When we're looking at the stocks we're invested in? So like if they had to let go of however many employees, maybe that hurts them now, but they're going to have higher profit margins in a few quarters because they have less overhead to pay. But that could signal like that's bad management. Why did they not have that more under control or like hired more people than they needed or whatever?
The why is really important. So why did something happen in the current environment? So right now, for example, there are a lot of layoffs happening. And I argue, and I want to go into the data, so this is pure speculation. Are the layoffs really happening because of artificial intelligence? Because that's a clear cop-out. Like when inflation was really, really high, we all know that it was really, really high. So are you raising your prices because you say, oh, it's inflation? Or did your cost go up? Did you really need to do that? Or same with tariffs.
You're just getting greedy.
Exactly. But meaning, if you say you're laying off because of artificial intelligence, from an objective standpoint, that is good management because you created efficiency. You can do more with less. And so you're not laying off to protect your profit margins. You're laying off to expand your profit margins, meaning that cop-out could be a cover for something else. That's why the why is really important. Why are you laying off? Because your sales aren't expanding and you're not making revenue. And so you need to protect your profit margins because that's what the Fed does, right? They raise interest rates to make everything so expensive. You don't buy as much. The companies realize less revenue. And then if they realize less revenue, they end up laying off because they have to protect their profit margins. That creates demand destruction, hopefully doesn't put us into a recession, and then inflation is tamed.
It also, though, can have a backlash because they're laying off people saying, even if it's a fake thing, if they're saying it's because of AI, that could cause a big cancel Amazon, ban Amazon, and they could lose profits in the long run.
Especially now.
Yeah. People are so quick now to be like, you know what? If you do that, we're not supporting you. And then we see it in the stock market. And it's been interesting. People are getting more wise to how this stuff works. I like to think it's because of financial literacy podcasts like us.
Oh, that. Well, and technology. The spreading of information has really changed since the .com era.
Yeah.
Bring it back to what we're talking about.
Yes.
It's newspapers to the internet to social media instantly.
Yeah. Well, here's the real takeaway. During bubbles, good companies and bad companies can look identical. Pets.com and Amazon were both internet companies. Both raised huge amounts of capital and both lost a lot of money during the boom. But only one had a real path to profitability and the ability to generate free cash flow over time. So hype can get you investors, but only cash flow can keep you alive.
Exactly. And if there's one lesson investors can learn from the .com bubble, it's this. Eventually, the market stops rewarding growth alone and starts demanding profits. So put your money where your mouth is. And when that shift happens, the difference between Pets.com and Amazon becomes very, very clear.
So what happened after the bubble burst? The party is over. The music changes to Closing Time by Semisonic, since we're in the 90s.
Oh, yeah.
The big bright lights come on and the room gets quiet. The bubble burst, the speculation ended, and everyone suddenly had to deal with reality.
When the .com bubble burst, the aftermath was an economic shock for the entire tech ecosystem, in addition to the stock market. Maybe that's why people confuse the stock market with the economy right there.
Yeah, the stock market is not the economy, but it does impact it because the stock market is just a bunch of companies, as we've said. 500 of the biggest U.S. companies, if we are to look at the S&P 500 to be exact.
Yes, such a great point. The companies failed, which means people lost jobs because it's companies that affects the economy. So between 2001 and 2003, the fallout was brutal. Tech hubs like Silicon Valley, they saw mass layoffs. Hundreds of thousands of workers lost their jobs. Startups just disappeared overnight, and entire industries that supported them, things like online advertising firms, web hosting companies, and suppliers to .com startups suddenly had no customers.
So this wasn't just the companies that failed. The ripple effects spread everywhere.
Yeah, exactly. When a bubble pops, the damage spreads through the entire ecosystem. It's like if you were to throw up glitter, it takes forever to get rid of it. It shows up in little places and you didn't even know it was there in little crooks and crannies. But there were even strange little signs of the collapse. So when startups shut down, they liquidated everything, computers, desks, equipment. There were so many failed startups in Silicon Valley that the Aeron office chairs flooded liquidation markets for pennies on the dollar.
Oh yeah, those ones were expensive. The unofficial furniture of the .com bubble.
And then there's the psychological impact. That was just as big. Computer science had been one of those hottest degrees during the tech boom. Like right now, how can we learn about AI? That's what we want to do. But after the crash, university enrollment in computer science programs, they actually dropped because the industry suddenly looked unstable.
Okay, what about the retail investors? I remember you saying this is when there was so much FOMO, everyone wanted in. Was there a .com era equivalent of Wall Street bets and finance bros?
Oh yeah, there was actually. So investors, they were shaken too, but especially retail investors. Retail investors feed into the hype and the FOMO more than anyone, because honestly, they're not confined by a lot of compliance is really my thought process. So during the late 90s, people were piling into internet stocks through early online investing platforms and discussion forums like Silicon Investor, Raging Bull, and The Motley Fools, which is still around. I love Market Foolery. Watch that one and listen to it for years. But after the crash, traffic on those forums, they collapsed by the mid-2000s. So social media even then was an indicator.
So investors basically lost trust in tech stocks.
For a while, yes, and trust is so important. Many people who lost money in the bubble swore off stocks entirely or moved into safer investments like bonds and cash, which is why understanding the cycle and where business goes is important. So surveys, they showed a generation of investors that felt genuinely traumatized by the losses, and it took years for confidence to recover. And I don't think it's even fully recovered yet.
Hence the name, the lost decade.
Yeah, that's when the lost decade came. And I remember we asked about that, or you asked about that, and there was a really good
I think a listener. Yeah, a listener asked about that one. I didn't even know what it was before.
Oh, yeah. So but that's what happened afterwards. Because if you're not spending money, the economy's not expanding, But this is where things get interesting. So even though a bubble destroyed a lot of companies, it left behind something incredibly valuable that we needed: infrastructure. During the late 90s, telecom companies spent billions laying fiber optic cables and building data centers to prepare for massive internet growth.
Oh, data centers, you say. Yeah. Sounds familiar.
Doesn't it?
But when that bubble burst, I guess demand disappeared.
Exactly. And so suddenly the world had a huge oversupply of internet bandwidth that caused the price of internet connectivity to collapse, which made high-speed internet dramatically cheaper. And that cheap infrastructure later enabled things like streaming video, cloud computing, social media, large-scale e-commerce, like little barcodes. Think about that, the addition of barcodes even. So in other words, the bubble built the highway system of the internet economy, and it was more attainable because of the supply and demand imbalance.
Yeah, I don't know if all y'all remember having to have dial-up internet, and it made those like awful startup noises before you could access the internet, and it like took a landline and all that. That was so annoying. I remember how long I would wait for things to load, how long it took to download a song, how long it took to like burn a CD, and then at
put
some
all the
point,
viruses on your parents' computer by using Kazaa or LimeWire.
Yep. Whoops. And
Jessica's Jam CD.
Yeah, that's right. We probably both had one labeled that.
Mine was full of like Avril Lavigne and Britney.
Oh, wow. Of course. Mine was all like 90s grunge and whatever.
It's fine.
Whatever I thought was cool at the time.
Yes.
So at least, I mean, it sucks for all those people who were investors back then and lost money, but it did pave the way for us to have what we have now on the internet. And the strong companies with the free cash flow survived that era and became a lesson learned for how to survive a crash. It's like the crash also acted like a kind of economic Darwinian filter. I guess you could think of it in that way. Like the weaker companies disappeared, but the stronger companies survived and came out leaner.
Yeah, companies like Amazon, they were born in this era. eBay, Cisco, they emerged from the wreckage stronger than before. New companies started building the next phase of the internet. So, for example, Google, Alphabet, they waited until 2004 to go public, long after the bubble had burst.
So the internet economy didn't die, it just matured.
Yeah, exactly. We didn't understand it. And sometimes we say that market crashes or market fallouts are a reality check, but it shakes out the bad people. That's just what happens because you have to be able to survive that. And to be able to survive that, you need good management. So important. Many of the ideas from failed startups, though, things like online groceries, online pet supplies, and digital marketplaces, they did eventually work later. The technology just needed time to catch up. Like literally, like I said earlier, barcodes became a thing. And I don't register because I think I was just so much younger at this time, but I think about just going to the store and even scanning myself with barcodes. Or like, have you ever been, I was at a gas station the other day and you could just put everything on a little weighing station. That's it. And then it told me how much it was. Like innovation. But things like that, you can do more with less. That's what we mean. Even something as small as the little weighing station or self-checkouts. You don't need as many employees. And that is what we mean with doing more with less.
So I guess investing behavior shifted when real revenue started showing up then.
Yeah, for a while, investors became, though, much more disciplined about valuations because like I learned from this lesson, I will not do it again. What's that saying? Fool me once, shame on you. Fool me twice, shame on me. That's what happened here. So startups, they started focusing on becoming cash flow positive, which means the business generates enough cash to sustain itself. Venture capitalists and investors, they wanted to see a clear path to profitability. Suddenly, that was a requirement. So that's what came out of it. Do you have free cash flow and do you have a clear path to profitability? And I say that all the time on finance media about artificial intelligence. And we do. And a lot of people do. And we're hung on those statements. And it's because of the .com era. We are afraid of this happening again, which is good. I mean, I think that makes it not a bubble.
Yeah, because hopefully we're learning from it. And I can't wait for that cash flow episode where you show us how to actually go find out where the company's free cash flow is.
It is a data point on your brokerage firm. You could look at free cash flow per share. You want to see a positive number. There's your high level. But yes, we will go in detail.
Good to know. There's got to be a place to find it and see it. So the mindset shifted from grow at any cost to prove the business works. What about regulation? Clearly, this is the wild, wild west out here with VCs throwing money at companies that do not have a clear path to profitability. And retail investors buy the shares once they IPO, and then the lockout period hits. So make that make sense.
Yeah. So the crash, it did also trigger regulatory changes. That's usually what happens. And if you think about it, presidencies are 4 to 8 years normally, and they should be. This is a long duration of a stock market crash. Part of fiscal policy is what are you going to do about it, right? So regulatory changes come in normally for that reason. What are you going to do about it? This happened. And that's also the responsibility of all of these governing agencies. So one major reform, I am probably saying this incorrectly, was the Sarbanes-Oxley Act of 2002. That tightened corporate accounting rules and forced executives to certify the accuracy of financial statements. The goal was to restore trust in financial reporting. Regulators also cracked down on conflicts of interest on Wall Street, especially analysts who were promoting stocks tied to their bank investment banking business. We didn't talk about this, but during the .com era, there were some analysts who held true to stock. There was buy ratings on pets.com when there clearly shouldn't have been. And they just held on to that.
Were they paid to inflate the ratings or something, or to make it sound better?
I don't know if they were paid to do that, or if they were stuck on the story, or if they had a vested interest because they owned that stock as well. But they were promoting stocks tied to their bank's banking business. So meaning the bank had the stock. That's a conflict of interest. And you need to definitely disclose that. And that's required now.
So analysts couldn't just hype companies their bank was helping take public anymore after that Sarbanes-Oxley Act.
Exactly. And when I worked at Merrill was actually helping with the Twitter and Elon Musk deal that happened.
Oh.
I wasn't allowed to buy any Twitter at that time. That's as a result of things like this. Just because I worked for the company and my job had nothing to do with that, but because I worked for that company, there was a list of stocks that if they were underwriting or working on something like that, I wasn't allowed to touch or even buy in my personal account. And this is the reason why.
It's a conflict of interest.
Yeah, even though I had no idea about it. Anyways, so the IPO market changed too, though. For more than a decade after the bubble, far fewer tech companies went public, and the ones that did were usually much more mature businesses. You couldn't just go public because you had .com by your name and you were making a company out of your garage. That quit.
So here's the strange part of the .com story. In the short term, it was a massive destruction of wealth, like the bubble bursting, that is. Massive destruction of wealth. The NASDAQ lost nearly 80% of its value. Thousands of companies just disappeared, and millions of investors lost money. But in the long run, the bubble accelerated the development of the entire internet economy. The infrastructure got built, consumers got comfortable using the internet, and the surviving companies like Amazon, Google, and eBay became some of the most important businesses in the world. The bubble got the timing wrong, but the technology right.
Exactly. And one of the most fascinating lessons in financial history is just that. Markets can be wildly wrong in the short term while still being right about the long-term direction of innovation.
So what are our conclusions for wrapping up this .com bubble? Let's sum it all up.
The .com bubble was a quintessential boom and bust saga, driven by transformative technology and wild speculation. And it ended in a very dramatic crash. I tried to be dramatic there. I don't know. It's great. Thank you. It causes ranged from easy money and investor euphoria to regulatory gaps and herd mentality.
Yeah, we still see that sometimes. The consequences were far-reaching. Enormous financial losses, a recalibration of how tech businesses are evaluated, and reforms in market oversight. Yet, out of the wreckage, the digital revolution continued and eventually fulfilled many of the bubble's promises, just on a delayed timeline and under different leaders.
Yeah. And today's episode really just stands as a reminder that while technology evolves, it compounds, it grows, does crazy things, like have AI agents with their own social media platforms. The fundamental principles of economics and investing, they do not. A compelling new industry can captivate the world, but ultimately cash flow and real profits have to justify valuations. So the dot-com era's lessons about speculative excess, that's overhype right there. Speculative excess is of a concern. That happened with GameStop. That's speculative excess. Market psychology, FOMO, right there. And the value of due diligence. So those three things I think are really important. Speculative excess tells us, is there overhype? Are we in this euphoric state? And is there something that is supporting it? On top of that layer is market psychology and market mechanics. I think that's really important. And understanding how a company actually makes money. That's your value of due diligence. Don't just go, this is what happens, is people even at this era, your neighbor is like, dude, you got to get into .com boom. Everyone is making money. Get pets.com. That same thing happened with GameStop. That is a bubble. And that's a really good example. It's a bubble based on one company with speculative excess, market psychology, and the lack of due diligence. This is just a bunch of companies. So same thing happened. Like this is where history repeated itself with GameStop. It repeated itself with cryptocurrencies. The same thing that happened with the .com boom did happen at cryptocurrencies. It hasn't happened with AI, but we're more afraid of it because people have this sour taste in their mouth with it. So it's still relevant, but all of this helps inform investors and policymakers whenever the next hot, quote unquote, trend starts to look too good to be true. We just go back to those things.
And I think, GameStop might have been a little bit more than speculative excess. Yeah, there's a lot going on there. And it was like a rally of the people supporting a company they liked and trying to change things.
But that's market mechanics. You're right, though. But that's herd mentality. If enough people are buying it, it does make the stock go up. But people need to continue to buy it.
Right. Like, this is how we take over the stock market. Let's do things. Just kidding.
I mean, we could.
Evil thoughts. And that is why studying financial history is so important, because markets may change, but investor behavior really doesn't.
Exactly. Also, this podcast was not running from August to mid-February. You guys binge listened, kept us on the charts, and even left us the nicest reviews that we cannot thank you enough for. I mean, that was a solid, 8 months where we weren't posting a thing.
Well, maybe not that much, but it was a while. Nice. We took a break. What are you trying to tell me, that we have a review to share?
Yeah, we do. We can. Thomas B, actually, first of all, he wrote a review asking if we were okay. And when will our next episodes come out?
That's very nice. Yeah, we were both hanging in there. We had a lot going on.
We did. And then once we released our first, so he did it 3 or 4 days before we released our next episode. And then he removed that review and then wrote another one thanking us, which was so nice. So here's what he said. The best comeback since 95. I wrote a review asking for their return and they're finally back! ! This season premiere was incredible. Thank you so much for the fresh insights and for starting the season with such high energy. You're welcome. Thank you. My favorite investment pod is officially back on top!
Aw, we love our listeners. We do not deserve them. Actually, we do. We all deserve each other. Thank you for being here. And thank you, Thomas. That was lovely.
It was. This is really nice.
It really keeps us going because, we got a lot going on and it takes a lot to make a podcast, but we're here for y'all. And you all are here for me, so I'm learning too. Learning with you. And if you're enjoying the Market Maker podcast, please take a second to rate, review, and follow the show wherever you listen, because it really helps us and it makes Jess's heart grow 3 times each time.
Does. Yeah, it does. And remember, when you build knowledge,
you break barriers.
Remember, investing involves risk. There is always potential to lose money when investing in securities. Market Maker provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by Market Maker on our website or podcast is not intended to be a substitute for professional financial advice. Market Maker is not liable for any investment decisions made based on our content.